India enters 2026 as one of the fastest-growing major economies in the world. While much of Europe continues to struggle with slow growth and aging populations, and China faces structural challenges related to demographics and property markets, India continues to grow at a pace exceeding most large economies. This growth is being driven by several forces simultaneously: consumer spending, government infrastructure investment, digital transformation, manufacturing expansion, services exports. Unlike previous decades, growth is no longer dependent on a single sector. Multiple growth engines are operating simultaneously. Why is this happening? Several structural factors are converging. India possesses one of the world's largest working-age populations. Urbanization continues. Internet penetration continues. Digital payments continue to expand. The government has invested heavily in physical infrastructure, including roads, airports, freight corridors, logistics networks. The result is a gradual reduction in economic friction. Why does it matter? Investors care about predictability. A country growing at 6 to 7% creates opportunities across banking, consumer goods, real estate, infrastructure, technology. Economic growth becomes a multiplier. When growth is sustained, businesses can grow revenues, even if they execute imperfectly. What could go wrong? Growth forecasts assume stability. Risks include energy shocks, global recession, inflation spikes, climate disruptions. A prolonged oil shock could weaken consumption. A weak monsoon could increase food inflation. Both would pressure growth. What should investors watch? Inflation, oil prices, fiscal deficit, employment creation, private capital expenditure. These indicators will determine whether growth remains sustainable. Political risk assessment. What is political risk? Political risk is often misunderstood. Political risk is not merely elections. It includes regulatory changes, tax policy shifts, trade restrictions, geopolitical tensions, administrative effectiveness. Countries can be politically stable and still carry significant political risk. India's political strengths. One reason investors continue to favor India is policy continuity. Long-term projects require confidence. Investors want to know that contracts will be honored, regulations remain predictable, infrastructure projects continue. Policy continuity reduces uncertainty. India's political vulnerabilities. India remains a federal system. Different states operate differently. Investors entering India often discover that labor regulations vary, infrastructure quality varies, administrative efficiency varies. The investment experience can differ dramatically across states. Geopolitical considerations. India operates within a complex geopolitical environment. Relationships with China, United States, Russia, Middle East must all be managed simultaneously. This balancing act creates both opportunities and risks. Key investor takeaway. The greatest threat is not domestic instability. The greatest threat is external shock transmission. Oil prices remain one of the most important political risk variables for India. Economic outlook. Consumption story. India's economy is increasingly consumption-driven. A large and growing middle class continues to spend on housing, education, healthcare, financial services, technology. This provides a stable foundation for growth. Infrastructure story. Infrastructure investment remains a major growth driver. Infrastructure improves productivity. A road is not merely a road. A road reduces transportation cost. Lower transportation costs increase economic efficiency. Efficiency increases productivity. Productivity increases growth. Manufacturing story. Manufacturing remains central to India's long-term ambitions. The goal is not merely economic growth. The goal is economic diversification. Countries that depend excessively on services often face structural vulnerabilities. Manufacturing creates broader employment opportunities. Labor challenge. Growth alone is insufficient. Employment quality matters. A country may generate GDP growth while still facing employment challenges. The long-term success of India depends on converting growth into productive jobs. Trinity insight. GDP growth is not the destination. Employment quality is. History shows that countries become wealthy when productivity and wages rise together. Section 4. Financial Risk Report. Fiscal risk. Fiscal risk measures the government's financial flexibility. Governments with excessive debt lose options. Governments with manageable debt retain options. India remains in a gradual fiscal consolidation process. Currency risk. Currency stability effects. Imports, exports, inflation, capital flows. Oil prices have a direct impact on India's external balance. A significant increase in energy prices can place pressure on the rupee. Banking system. The banking sector is healthier than it was a decade ago. Balance sheets have improved. Asset quality has improved. Capital levels have strengthened. However, rapid credit growth always deserves monitoring. Capital markets. India's capital markets continue to deepen. Domestic investors increasingly provide stability. This reduces dependence on foreign capital. Trinity insight. The greatest financial vulnerability remains external energy dependence. Many other financial risks ultimately connect back to oil. State business environment rankings. Why state rankings matter. Many foreign investors think of India as one economy. In reality, India functions more like a collection of regional economies. The differences can be substantial. Infrastructure differences. Some states possess better roads, better ports, better airports, better logistics. These advantages attract investment. Talent differences. Some states possess stronger educational ecosystems. Human capital attracts industries. Industries attract capital. Capital attracts further talent. The cycle becomes self-reinforcing. Reform differences. Administrative efficiency varies. Business friendliness varies. Execution quality varies. These differences affect investment outcomes. Trinity insight. The question is not, should we invest in India? The question is, which India are we investing in? Long-term growth outlook. Demographics. India's demographic profile remains one of its strongest advantages. A large working-age population can become a powerful economic engine. But demographics alone do not create prosperity. Urbanization. Urbanization increases productivity. Cities create scale specialization innovation. Economic history repeatedly demonstrates this pattern. Technology. India has become a global digital leader. Digital payments. Digital identity. Digital public infrastructure. These developments create economic efficiency. Climate risk. Climate adaptation may become one of the defining economic challenges of the coming decades. Water stress, extreme weather, agricultural disruption, energy transition, all carry economic implications. Education and skills. The future depends on workforce capability. The key question is not, how many people are available? The key question is, how many are employable in a modern economy? Final Trinity insight. India's long-term story is neither guaranteed success nor inevitable failure. The outcome will depend on execution. The country has the scale, the demographics, the market, the capital, the opportunity. The remaining question is whether execution can consistently convert potential into prosperity. That is the question investors should continue to watch throughout the next decade.